Hello, my dear long-term investors. This is Bhuvi. Today we are going to talk about a macroeconomic topic which is abstruse and complicated. This video is specially to the investors who are all really want to know about this subject. So it's going to be little bit lengthy and boring. Only the interested guys should watch this. And this is not for everyone, and it is not for the passive investors. And let's get into the video, guys. So before getting into the video, you have to know the basic meaning about the terms I'm going to mention in this video. So first you have to know the meaning of spread. What is spread? So spread is nothing but if I'm borrowing something for 1,000 rupees at 5% interest, and I'm investing the 5%. If I'm investing the 1,000 rupees in some financial instrument which gives me 7% return, so the 5% I will pay the 5% interest and take the difference. I'll pocket the difference, which is 2%. That is the spread. Okay, so let's go to the one more term, which is earnings yield. Earnings yield is nothing but a inverse of P ratio. If a company earns 1 rupee and if the stock is trading at 10 rupee, so let's say what is the earnings, which is 1 rupee. So I'm putting E as a numerator, 1 rupee as a numerator, and what the price, it's 10 rupee, and 10 rupee as I'm putting 10 rupee as a denominator. The answer is 10. So the earnings yield is 10%, right? Earnings yield is nothing but what the security is giving you in return for the amount you have invested. Okay. So next we are going to talk about the relation between yield and price of bonds. So let's say yield and price of bonds will travel at a opposite direction. If a price of a bond increases and at the same time the yield of a bond will decrease. So let's say if I'm issuing a bond for 100 rupee at a 5% yield, if you invest 100 rupee to me, I will give 5%. If the demand for bond is very high at market, the bond may trade at 101 rupee. So I'm going to give only 5 rupee, but the price have increased so that the yield will decrease, right? You have got it. And this will happen in vice versa. If the demand decreases and the yield will increase. Okay. In market, why the demand of a bond will increase? When the government is in the decision to increase the interest rates which they are going to provide for that bond. Okay. If the inflation is not yet it's extinguished to the tolerance level of a RBI or a Federal Reserve, the market will expect they are going to raise the interest rate one more time. So the new bonds which are all at the higher interest rates will trade at market. So the price of this bond will discount and the old bonds will be matched to the rates of the new bonds. Okay, right. In February 1, the Federal Reserve paused the interest rates at 5.25 to 5.5. The Federal Reserve in February 14, I think so, expected the inflation to be at 2.9%, but all of a sudden it gave a result of 3.1%, which is 0.2% higher than the expected rate. So what's the news? So what's the point I'm going to talk about is Sensex yielding, Sensex yield gap with the 10-year US bond turns negative. Okay. What is yield of a Sensex? If I'm summing up all the earnings of a company which are all included in Sensex, which is 30 companies, and I'm summing up all the prices of the stocks which are all traded in Sensex and dividing it, earnings divided by price. So it gives earnings yield of 4.1%, right? US government bonds are trading at 4.33, which have raised in this calendar year. In the start of this calendar year, it started with 3.87, and it now shot up to 4.33%. Okay. If I am a foreign portfolio investor, if I am a FII, foreign institutional investor, I'll see this negative correlation between, negative spread between the Sensex and the 10-year US government bond. So if I'm invest my money in a government bond in US, it give 4.33% return. At the same time, in the Sensex, it only give 4.1% return, which is the 0.21% negative return. So no fool will do it. And this is an indication that market might experience a sell-off by foreign institutional investor. If they sell, they are the major player in equity market. If they start to sell, the market might experience a correction. So this is a one negative thing for market. And one more thing is, BSE Sensex is trading at a P ratio of 24.9 yesterday, and today it's at 24.6, I think so. So the average P ratio of Sensex, around 18 to 20 in the historical levels, I say. So it's a market is trading at a premium. The valuations are too high. So it might be a double whammy effect for our market. So this negative return was occurred after 15 years. And sorry for the silence. And in September last year, it happened a negative spread, and the Sensex gave a yield of 4.14, and treasury bills of US gave a yield of 4.58, which is a minus 0.44 return. So the market experienced a sell-off. So then rallied again as CPI in US decreased. If CPI in US decreased, so what's the correlation? Yeah, I'm going to say. If the CPI inflation is decreased, the Federal Reserve will think about cutting interest rates. If interest rate decrease, the new bonds will be issued at a lower interest rate, which will lead to a positive spread. So that's why after sell-off in September, the market have rallied in November and December to the new heights. So today's video, the essence of the video is nothing but the yield gap was in negative, so it might experience a sell-off. And one more thing is, the P ratio of Sensex it at some premium valuation, but from its historical levels, so it might become a double whammy effect in the markets. It might dawn on the market. So we should be aware, and we should only invest in the value stocks, which are all trading at cheap value. In the cheap price. And that's today's video. I think this video might be mind-boggling. If you are not satisfied, please go and watch this twice or thrice until you grasp the concept. And thank you for watching this video till the end. I hope you have understand something, and thank you for watching